The tape is deceptive right now. If you just glanced at the closing bell, you'd see the major indices, the S&P, NASDAQ, Dow, nudging higher, drifting on this lazy positive inertia. Industrial, healthcare, and material stocks are leading the charge, while energy and consumer staples are dragging the anchor. But that's the polite version of the story. Beneath that calm surface, the water is chopping violently. We aren't seeing a unified bull market. We're seeing a capital rotation where the winners are being decided by very specific, very technical supply bottlenecks. Let's start with the narrative that's sucking up all the oxygen in the geopolitical room, the sudden push to revitalize Venezuelan oil. You're hearing a lot of noise about a grand bargain, U.S. companies fronting capital, potentially north of $100 billion over a decade, to rehabilitate PDVSA's infrastructure. The logic on paper is that the U.S. gets a strategic foothold, Venezuela gets cash, and global supply stabilizes. But let's look at the physics of this trade, not the politics. Venezuelan crude isn't like the light sweet stuff coming out of the Permian. It is heavy, sour, and difficult to refine. The infrastructure there hasn't just been neglected, it has been cannibalized. We're talking about rusted pipes, non-functional upgraders, and a brain drain of petroleum engineers that took 20 years to happen. Even if, and it's a massive if, you get optimal U.S. involvement in sanctions relief, analysts are modeling a clawback to maybe 1.4 million barrels a day within 2 years. To put that in perspective, that is a rounding error. It's a drop in the bucket against a North American supply chain that is currently overflowing. We are sitting on the largest crude surplus since the year 2000, excluding the anomaly of the pandemic lockdowns. The market knows this. That's why Brent is pinned near $61, with the forward curve pointing to the mid-50s. The algo traders and the macro funds aren't buying the Venezuelan renaissance story because the supply math doesn't work. The real trade here isn't going long oil on a geopolitical headline. It's understanding the pressure on the U.S. producers. They are victims of their own efficiency. They've become so good at fracking that they've capped their own upside. This is exactly the kind of counterintuitive setup where the headline says bullish intervention, but the data says bearish glut, that we spend a lot of time dissecting on Open Fieldbook. It's about stress testing the narrative against the actual barrel count.
Now, pivot that idea of efficiency bottlenecks to the engine room of the modern economy, artificial intelligence. Jensen Huang and Nvidia are dominating the news cycle out of CES again. The next generation chips slated for late 2026 promise another quantum leap in compute density. And sure, the physical AI narrative, robots, autonomous systems, the tangible world, is sexy, but if you look at the order books, there is a massive collision happening. The processing power is outpacing the memory required to feed it. We are running headlong into the memory wall. Nvidia's GPUs are Ferraris, but they're running on dirt roads if the memory bandwidth isn't there. We are seeing a crunch in high bandwidth memory, or HBM. Prices for premium DRAM are up 60% this quarter alone. The forecasts I'm looking at suggest another 40% hike is baked in for the next 6 months. This creates a fascinating divergence in the semi-sector. Nvidia designs the chips, but they don't make the memory. That falls to players like Micron, SK Hynix, and Samsung. And right now, those memory makers have pure pricing power. It's a classic seller's market. Here is the twist that the generalist media is missing. The hyperscalers, Microsoft, Amazon, Google, are caught in a vice. They have to buy Nvidia's latest chips to stay competitive in the AI arms race, but because the memory costs are skyrocketing, their total cost of ownership, TCO, is ballooning. They're paying premiums that are eating into the efficiency savings the new chips were supposed to provide. This compresses the innovation cycle. It forces these companies to find revenue now. They can no longer afford to just build capacity for the future. The capex bill is too high. They need to justify the spend to Wall Street. For the investor, this means the AI trade is narrowing. It's no longer enough to just buy the index or buy the biggest tech stock. You have to look at the component suppliers who have the leverage. Micron and Western Digital have been on a tear, not because they are AI companies, but because they control the bottleneck. Identifying these second derivative beneficiaries, the companies selling the picks and shovels to the miners, is a core part of the analysis we run for subscribers at Open Fieldbook. It's not about guessing the winner of the AI war. It's about owning the toll booth on the road to the battlefield.
Speaking of toll booths, let's talk about the most constrained resource of all, power. This brings us to Bitcoin, which just pushed back above 94,000. Technically, breaking that 50-day moving average is significant. It forces the momentum traders to take a position. But if you're looking at the price chart, you're missing the real story. The price is just the scoreboard. The game is being played in the energy grid. The institutional embrace we are seeing right now is staggering. We had over $1 billion in inflows into U.S. spot Bitcoin ETFs in just the first 2 trading days of the year. BlackRock's IBIT fund pulled in $372 million in a single session. That is institutional asset allocation models rebalancing in real time. It legitimizes the asset class in a way that makes it safe for the massive pension funds and endowments to dip their toes in. But here is where it gets interesting for the equity investor. Look at the deals happening between the tech giants and the crypto miners. You have Microsoft and Google signing massive agreements with former crypto mining companies and nuclear operators. Why? Not because they want to mine Bitcoin, because they need the power. Crypto miners spent the last 5 years securing gigawatts of grid connection and building massive data centers with sophisticated cooling. Suddenly, in an AI world starved for energy, those leases are gold. We are seeing a land grab for power capacity. A Bitcoin miner with a 200 megawatt connection is no longer just a crypto company. They are a prime acquisition target for a hyperscaler who needs to train a model. This is the energy arbitrage. The market is realizing that a kilowatt hour of energy might be more valuable powering an AI inference engine than mining a Satoshi. This is lifting the entire energy complex, nuclear, natural gas, grid infrastructure. The upgrade of Coinbase by Goldman Sachs isn't just about crypto trading volumes. It's an acknowledgement that this entire ecosystem is becoming a permanent layer of the financial and technological stack. If you're trying to play this, you can't just buy Bitcoin. You have to look at the utilities, the nuclear small modular reactor startups, and the miners pivoting to high-performance computing. That's a complex web of correlations.
Now, let's move up a level to the people managing the money. There is a reckoning happening in the hedge fund world that is going to shape capital flows for the rest of 2026. Last year created a massive bifurcation. On one side, you had the tiger cubs, the concentrated long-only or long-biased stock pickers. They took massive conviction bets on tech and growth, and many of them racked up gains of nearly 40%. They swung the bat and they connected. On the other side, you have the pod shops, the massive multi-strategy platforms like Millennium or Citadel. These firms are designed to engineer away risk. They neutralize market beta so that they theoretically make money whether the market goes up or down. But in doing so, many of them delivered returns in the low single digits last year. Here is the problem. In a raging bull market, risk mitigation looks a lot like opportunity cost. Allocators, the people who manage money for sovereigns and pensions, are looking at this and asking tough questions. Why pay pass-through fees that can amount to 5 or 6% of assets just to get a return that barely beats a risk-free treasury bill? This exposes a fundamental tension in modern portfolio management. We have engineered the volatility out of the system so effectively that we may have engineered the alpha out with it. The multi-strats are so big and they are all chasing the same arbitrage opportunities that the trades are crowded. The basis trade in treasuries, the dispersion trades and options, they're all getting squeezed. For 2026, the smart money is moving back toward conviction. You're going to see flows leaving the black box strategies and moving toward managers who actually take a view on a company's future. But this requires work. It requires actual analysis, not just algo-driven arbitrage. This is where the individual investor has an edge. You don't have to run a market-neutral book. You don't have risk limits that force you to sell a winner just because it went up too fast. You can hold conviction. But to do that, you need data that cuts through the noise. You need to be able to look at a company's fundamentals without the distortion of the hype cycle. That's the conversational partner we built at Open Field Book. We aren't telling you what to buy. We are giving you the tools to validate your own conviction so you can sit tight when the volatility hits.
Finally, we have to talk about the bond market, because it is currently shouting at the equity market, and the equity market is pretending not to hear it. The yield curve is steepening. The gap between the 2-year and the 10-year Treasury is widening to levels we haven't seen since late 2021. In a normal textbook economy, a steepening curve is a sign of optimism. It means growth is returning. But we aren't in a textbook economy. The bond market is pricing in sticky inflation. Traders are demanding a higher premium to hold long-term debt because they don't believe the Fed is going to get inflation back to 2% and keep it there without breaking something. Yet, simultaneously, the futures market is pricing in 2 rate cuts this year. Those two things are contradictory. You can't have a booming economy that justifies high long-term yields and a Fed that needs to cut rates to save the economy. Something has to give. Adding to this confusion is the behavior of corporate America. We saw nearly $40 billion in investment-grade bonds flood the market on Monday. CFOs are rushing to issue debt. Why? Because they're scared rates are going higher, or because they want to lock in cash before a recession? It smells like a bear steepener, where long-term rates rise faster than short-term rates. That is tightening financial conditions, even if the Fed does nothing. It makes mortgages more expensive, it makes corporate borrowing more expensive, and it eventually sucks liquidity out of the stock market. So here is the board as we see it. You have a commodity play battling a global supply glut. You have a tech boom that is being constrained by its own supply chain physics. You have crypto finding institutional footing by morphing into an energy play. You have a hedge fund industry having an identity crisis, and you have a bond market that is flashing a warning sign about inflation and debt. It is messy, it is fractured, and that is exactly where the opportunity lives. The big trends, AI, energy, sound money, are creating winners and losers in very specific pockets. The rising tide lifts all boats era is over. Now you have to pick the right boat. For those of you looking to stay ahead of these fractures, to understand the difference between a memory bottleneck and a demand slump, or to parse the signal from the noise in the bond market, come stress test your thesis with us. The tools at openfieldbook.com are built for this exact complexity. Don't trade on the headline, trade on the reality. We'll be watching the CPI prints closely later this week. Until then, stay sharp.